Stop whatever you're doing right now. Seriously. Pause the music, close the extra tabs, and put your phone face down for a moment. If your dog is staring at you, tell him you will take him for a walk later. This matters more than whatever you were doing a minute ago. Step away from the noise, because what you are about to hear requires clarity. If you own silver in any form, physical bars, coins, exchange-traded funds, futures contracts, or anything tied to the metal, do not open your brokerage account yet. Not now. Looking too early will push you into panic or celebration, and right now, both reactions will blind you. Take a breath, stay with me, because what I am about to explain would have sounded impossible just 24 hours ago. My name does not matter as much as the moment we are living through. Today is Wednesday, January 14th, 2026, and the silver market just crossed a line it has never crossed in modern financial history. Yesterday, we talked about how exchanges tried to crush the rally by raising margin requirements, shifting rules, and forcing retail traders to liquidate. That strategy has worked many times before. This time it failed. Not slowly, not quietly. It failed in the most spectacular way possible. The reason it failed is simple, even if the implications are terrifying. The paper market no longer controls the price. For decades, silver pricing was dominated by screens, algorithms, leverage, and contracts backed by promises instead of metal. Everyone was taught that physical supply did not matter, that there would always be enough silver somewhere. That illusion shattered today, not because of emotion, not because of speculation, but because reality finally collided with math. And when math wins, narratives collapse instantly. Here's what happened. The futures market in Shanghai closed dramatically higher, while the paper price in New York barely moved. Two prices now exist for the same metal at the same time on the same planet. This is not supposed to happen. In a functioning market, arbitrage would erase that difference immediately. Traders would buy where silver is cheap and sell where it is expensive until the gap disappears. That is how markets are designed to work. Except now, the gap is widening, not shrinking. And that tells us something fundamental is broken. The reason the gap is not closing is the most important thing you need to understand about silver right now. There's no metal left to move. Western vaults are drained. Inventory that was supposed to back every contract, every share, every promise is gone. It did not disappear overnight. It was quietly removed months ago by capital that saw this coming. And now, the system is failing in real time, right as you are watching this. What comes next will force you to rethink everything you thought you knew about silver. Let me show you the numbers, because numbers do not lie. Opinions lie. Institutions lie. Media narratives lie. But math is ruthless. Yesterday, the price gap between the Eastern physical market and the Western paper market was already abnormal. Today, that gap exploded. The price paid for real silver in Asia surged sharply, while the paper price in the West lagged behind. This divergence is not noise. It is evidence. It is the market signaling that the mechanism used to set prices no longer reflects reality. In a healthy market, this situation cannot persist. Arbitrage exists to eliminate price differences. Traders buy low in one market, move the asset, and sell high in another. That process continues until prices converge. That is not theory. That is the foundation of global trade. But what we're witnessing now is something entirely different. The gap is not closing. It is expanding. That tells us arbitrage is no longer functioning, not because it is unprofitable, but because it is impossible. The bridge between these markets has collapsed. There is no freely available silver left in Western vaults to move. The metal that was supposed to support paper contracts has already been withdrawn, claimed, or promised multiple times over. When institutions attempt to source physical silver, they come up empty. Dealers are out of stock, mints are delayed. Inventory reports show depletion, not replenishment. The metal is gone, and without metal, arbitrage dies. This creates a dangerous split. One market exists only on screens, built on leverage and settlement promises. The other exists in the real world, where buyers demand immediate delivery and are willing to pay whatever is necessary to secure it. These two realities can coexist only for a short time. Eventually, one must dominate the other. History is very clear about which one survives when trust breaks down. What you are seeing is not a spike. It is not a squeeze. It is not a temporary dislocation. It is the early stage of a structural repricing. The paper price is not leading anymore. It is following, slowly and reluctantly, while the physical market moves ahead without waiting for permission. That shift changes everything, because once price discovery leaves the paper system, it does not come back quietly. Yesterday, the system tried one last familiar move. Margin requirements were raised, rules were adjusted, pressure was applied, where it always is, on leveraged participants who cannot hold through volatility. The goal was simple: force selling, create fear, and manufacture a pullback that would restore control. This strategy has worked for decades. It has crushed countless rallies. This time it failed. For a brief moment, it looked like it might succeed. Prices dipped. Some positions were liquidated. Weak hands were shaken out. But then something changed. Physical demand stepped in and absorbed everything. The paper selling ran into a wall of real buyers who were not trading for profit but for necessity. The supply available at lower prices simply vanished. That is the point most people miss. When price is driven by necessity instead of speculation, the rules change. Industrial users, sovereign interests, and long-term holders do not care about short-term charts. They care about access. They care about continuity. When they sense risk to supply, they do not wait for confirmation. They buy immediately, and they buy aggressively. This is where the pressure shifts from retail traders to the core of the system. Large financial institutions have relied on paper mechanisms to suppress price and manage exposure. Those mechanisms only work when physical supply is abundant. Once that supply tightens, every short position becomes a liability instead of a strategy. The higher the price moves, the more unstable the structure becomes. Now the system is trapped between two unacceptable outcomes. If prices are allowed to rise freely, losses escalate rapidly and confidence erodes. If control is forced through intervention, credibility collapses even faster. Either path leads to the same destination. The only difference is speed. And right now, the market is choosing speed. This is where the situation becomes dangerous for institutions that believed they had time. Banks and large intermediaries built their exposure, assuming they could always roll positions, settle in cash, or source metal later. That assumption only holds when supply is flexible. Once supply tightens, every delay becomes a risk, every promise becomes a question, and every short position starts behaving like an open wound. The problem is not just price, it is credibility. When buyers begin to doubt delivery, they stop accepting substitutes. Cash settlement is no longer seen as neutral. It is seen as failure. And once that mindset spreads, the entire paper structure weakens. Contracts lose meaning if they cannot guarantee access to the underlying asset. Screens stop being trusted when reality diverges too far. This is why the reaction is happening quietly but decisively. There is no panic yet, because panic is a retail phenomenon. What we are seeing now is strategic repositioning. Capital that understands cycles moves first, long before headlines change. It exits fragile structures and migrates toward assets that cannot be diluted, rehypothecated, or delayed. That migration is already underway. At this stage, intervention becomes less effective with every attempt. Each failed effort reinforces the perception that control is gone. Markets are psychological systems built on confidence. Once confidence cracks, force only accelerates the breakdown. History shows this pattern repeatedly, across currencies, commodities, and empires. The response that worked yesterday becomes the catalyst tomorrow. What matters now is not the next headline, but the next behavior. Watch what stops being sold. Watch what cannot be sourced. Watch where premiums refuse to collapse. Those signals reveal more truth than any official statement. Price does not move first. Availability does. And availability is already tightening beyond repair. What is unfolding now goes far beyond a single metal. Silver is simply the pressure point where the fracture became visible first. When a market built on leverage loses access to its physical foundation, the issue spreads outward. Confidence does not fail in isolation. It cascades. Once participants realize that one price is fictional, they begin questioning every other price built the same way. This is why currency trust enters the conversation. Silver is not just an industrial input, it is also a monetary metal. When its real price detaches from the paper system, it exposes the weakness of the unit used to price it. Buyers paying higher premiums are not speculating. They are voting. They are expressing a preference for tangible value over abstract claims. That vote is quiet, but it is relentless. You can already see this behavior across markets. Capital is rotating away from long-dated promises and into assets with immediacy. Not because investors are emotional, but because risk models are changing. When delivery risk rises, time itself becomes expensive. Owning something later is no longer equivalent to owning it now. That distinction reshapes portfolios at the institutional level. This is how power and price discovery shifts. For decades, pricing authority belonged to paper markets and financial centers. That authority depended on trust and excess supply. When supply tightens and trust erodes, price discovery migrates to where transactions are settled physically. Screens follow, they do not lead. And once that migration begins, it is extremely difficult to reverse. The system does not collapse in a single moment. It drains, liquidity thins, spreads widen. Exceptions become normal. What looks like stability from a distance is often just delay. By the time official acknowledgement arrives, the adjustment is already complete. The repricing does not announce itself. It simply finishes. At this point, the question most people ask is what happens next. They want dates, targets, and precise outcomes. That instinct is understandable, but it misses the nature of transitions like this. Structural shifts are not linear events. They unfold through pressure, resistance, and eventual release. The exact moment is never predictable, but the direction becomes unavoidable once key thresholds are crossed. The most fragile part of the system is not price volatility. It is settlement. When markets begin to rely on exceptions, delays, or alternative payouts, confidence decays rapidly. Participants stop assuming fulfillment and start planning around failure. That behavioral shift changes everything. Once enough actors think this way, liquidity evaporates, even if prices remain quoted. This is why attempts to restore control often backfire. Measures designed to calm markets signal stress instead. Restrictions, meant to protect stability, expose vulnerability. Every intervention teaches participants what the system fears most, and markets are ruthless students. They learn quickly and respond faster than policy can adapt. What follows is usually a rapid repricing, not because demand explodes overnight, but because supply refuses to surface at previous levels. Sellers step back. Offers disappear. Buyers compete quietly, then openly. The screen price jumps to catch up with transactions that have already been happening off-screen. By the time it moves, the real shift is already behind us. This is the final stage where observers still have time to understand what is happening. Once the repricing becomes obvious, decisions turn reactive. Options narrow. Flexibility vanishes. Markets reward preparation, not speed. And preparation begins with recognizing when the rules that governed the past no longer apply to the present. The final misunderstanding to clear is the idea that this situation resolves by returning to normal. Systems rarely revert after credibility breaks. They adapt or they fracture further. Once participants realize that paper pricing can diverge indefinitely from physical reality, behavior changes permanently. Risk is no longer abstract. It becomes logistical, legal, and temporal. Ownership is redefined by control and access, not by statements or confirmations. This shift does not require collapse headlines to function. It advances quietly through refusals, delays, and preferences that slowly rewrite how value is measured. Another critical point is that this repricing is not driven by fear, but by replacement cost. When producers, refiners, and end users realize that future supply cannot be guaranteed at current prices, their willingness to sell disappears. They stop viewing inventory as stock and start viewing it as insurance. That change alone removes liquidity from the market. Prices do not rise because people are excited. They rise because sellers step away. Absence, not aggression, is what ultimately forces repricing. This is also why volatility becomes asymmetric. Downward moves rely on available supply. Upward moves rely only on urgency. When supply is constrained, downward pressure weakens structurally. Any dip becomes an opportunity to secure what may not be available later. That dynamic creates a staircase effect where corrections shorten and recoveries accelerate. Observers misinterpret this as speculation, but the driver is risk avoidance, not optimism. It is the logic of survival within a constrained system. What many fail to grasp is that physical markets do not negotiate with narratives. They negotiate with availability. If the metal cannot be sourced, price loses its disciplining function. It becomes descriptive rather than controlling. Screens report what already happened elsewhere. By the time consensus adjusts, the transaction is passed. This is why late recognition feels sudden. The event did not happen overnight. Awareness did. At this stage, official explanations become less relevant than informal signals. Extended delivery times, conditional offers, and shifting terms reveal more than statements ever could. When guarantees quietly soften, when alternatives are suggested, when fulfillment language becomes flexible, the structure is already compromised. These details rarely trend, but they define the real boundary of trust. Once crossed, participants stop expecting restoration and begin planning for continuity without the system. It is important to understand that this is not a judgment on intent. Systems behave this way regardless of motives. When leverage exceeds physical backing, instability is mathematical, not moral. The outcome is determined by constraints, not decisions. Attempts to delay resolution often amplify its eventual force. Compression builds where flexibility once existed. When release comes, it appears dramatic only because the tension was ignored. What remains now is not prediction, but recognition. Recognition that price is no longer a guide to availability. Recognition that timing matters more than confirmation. Recognition that markets do not warn loudly before they change regime. They signal softly, repeatedly, until those signals are no longer needed. The transition underway is not about panic or profit. It is about the quiet redefinition of what ownership means when systems move from trust to verification. If this analysis helped you see beyond the number on the screen, take a moment to support this work. Subscribe to the channel, leave a like, and share this video with someone who still believes price always reflects reality. The conversation in the comments is where understanding deepens, because markets do not change through headlines, they change through awareness. And if you want to take the next step in this reflection, watch the video that is appearing on your screen now.